Let's talk about the accounting cycle. So there's 9 steps in the accounting cycle. Your first step is to analyze business transactions. So when you're analyzing business transactions, you need to be thinking about, okay, which accounts are affected? Then, are these accounts increasing or are they decreasing? And by how much? So a quick example. On January 10th, you received $1,000 for services performed. So which accounts are being affected? Your cash and your service revenue are both affected here because we are receiving cash and we performed services. Now, are they increasing or decreasing? Well, our cash is increasing because we are getting money, and our service revenue is also increasing because whenever we perform services, our revenues increase. And by how much? That's just that $1,000. So, after you analyze your business transactions, then you can journalize the transactions. So this is putting these transactions into journal entry form. So based off of the transaction analysis that you did, you think about, okay, which account is debited and which account is credited in the journal entry. And this is where knowing your normal balances will come into play. So knowing that your assets, drawings, and expenses all increase with a debit, and your liabilities, capital, and revenues all increase with a credit. So based off of that same example problem that we had in step 1, this would be your journal entry. Your cash had to increase. Well, cash is an asset, so to increase an asset, you debit it. So we debit cash for $1,000. Then service revenue. Service revenue also increased. Service revenue is a revenue account, and revenue accounts increase with a credit. So we credit our service revenue $1,000. You'll notice your debit is listed first, and your credit is indented. So that's going to be the case in every single journal entry. After you journalize your transactions, you can then post them to a ledger or to T accounts. Let's first talk about a ledger. So a ledger would look like this. You'd have your account, right? Cash, and then the date of the transaction. Then the reference column, this shows which page in the journal that journal entry's in. So we're just going to assume that it's the first page of the journal, or J1. And then we show that we debited cash $1,000. And then we have to update our balance, because in a ledger, we keep a running balance for every single account. Then we also want to post the information to service revenue. So again, the date, the reference is the same as the cash, but here we credited service revenue $1,000. So we put that $1,000 over in the credit column, and then we update its balance as well. Now you could also post your entries into T accounts. So this is what a T account would look like. And on the left side of a T account, you put your debits, and on the right side of a T account, you put your credits. So here we debited cash and credited service revenue. So your T accounts would look like this. After you post to the ledger, then you can prepare a trial balance. So there's a few steps to preparing a trial balance. First, you list out the account titles and their balances in either the debit or the credit column, depending on their normal balance. Then you add up the debit and the credit columns. And then lastly, you prove that the total debits equal the total credits. So a trial balance would look something like this. So you'll notice how these accounts are listed. They're listed in the order of assets, liabilities, owner's capital, owner's drawings, revenues, and expenses. that order is the same order as your expanded accounting equation. And then if we look more closely at just the assets, your assets are listed in order of liquidity. That's how quickly you can turn an asset into cash or how quickly you're going to use up that asset. So after you prepare a trial balance, then you can journalize and post your adjusting entries. So we have a few rules for adjusting entries. First, every adjusting entry is going to include one income statement account and one balance sheet account. So you're either going to debit an expense or credit a revenue in every single adjusting entry. And you will never include cash. So after you journalize all these adjusting entries, then you post them just like we did earlier in the accounting cycle. And once you journalize and post all of your entries, then you can prepare an adjusted trial balance. Now, an adjusted trial balance is pretty similar to a trial balance that we just talked about. Your 3 steps, you list out the account titles and their adjusted balances in either the debit or the credit column. Add up those 2 columns and prove that they equal. Right, so these accounts will now have updated balances. You might have additional accounts that you didn't previously have in your original trial balance, but the idea is still the same. You list out your accounts, their balances, and make sure that the total debits and credits equal. So once you have an adjusted trial balance, then you can start preparing your financial statements. So, your financial statements are prepared in a certain order. First is your income statement, then your owner's equity statement, then the balance sheet, and then the statement of cash flows. And there's a reason why we prepare them in this order. So, in order to prepare an owner's equity statement, we first need the net income or loss that we found on the income statement. Then, in order to prepare a balance sheet, we need the ending owner's capital amount that we found on an owner's equity statement. And then on the statement of cash flows, we use the cash balance that we have on the balance sheet. So after we prepare our financial statements, we can then journalize and post our closing entries. So there's a process here for closing entries. First, we close our revenues to our income summary. After we close our revenue accounts, then we close expenses to income summary. After we close our expenses, we then close income summary to owner's capital. And our final closing entry is closing owner's drawings to owner's capital. So, your revenue accounts, expense accounts, income summary, and owner's drawings, those are the accounts being closed. Those are your temporary accounts. Owner's capital is involved, but owner's capital is never being closed itself. Accounts are being closed to owner's capital. So your owner's capital account remains open because it is a permanent account. So after we journalize and post those closing entries, then we can prepare a post-closing trial balance. Again, pretty similar to the other trial balances that we've prepared so far. The difference, we only show permanent accounts. So we're only going to show our assets, liabilities, and owner's capital on a post-closing trial balance. And we want to make sure that we're using the updated balance for owner's capital that we found after our closing entries. And of course, we want our total debits to equal our total credits. So your post-closing trial balance would look something like this, right? You list out your assets, you list out your liabilities, and then you list out your owner's capital. You add up your debit column, you add up your credit column, and your total debits have to equal your total credits. So that's your accounting cycle, right? After we prepare a post-closing trial balance, it all starts back up again.